Tonight, we're going to be talking about your adult report card. And that adult report card is also known as your credit report. A lot of people, they just give up. A lot of people just listen to Dave Ramsey and they're like, I don't need credit. They give up. It's like the D student. I'm stupid. I'm not going to college, so I'm not going to do the work. I'm just going to get D's and F's and just skate my way through. So let's talk about your GPA. And your score is your GPA. Your credit score is your adult version of your GPA. And tonight we're going to be talking about how you can increase your GPA. So the first section I want to talk about is how to increase your GPA and then how to have a thicker credit file. A thick credit file is how long you had it. So earlier today, I did a consult for a gentleman and his mother, so he was born in 1983. So what's that make him? He'll be 40 this year. Yeah, so 40 years old in November. So he'll be 40 in November. And when he was a small child and through teenage years, his mom put him, as every mom should do, put him on all of her credit cards. And so because of that, he has a very thick credit file. And in fact, because of the thick credit file, even though he had 6 accounts that had gone late in the past, he still was 770s, 790s. Now, he wanted to get into the 800s, so he hired me to remove these late payments as well as get some business funding. And getting rid of the late payments is going to help get the business funding. And I'm not too worried about getting these accounts completely deleted from his credit report because he has such a thick credit file, because he's had credit essentially for 30 years, even though he's only 40 years old. And it's because his mother put him on her credit report as an authorized user. And I highly recommend that you do the same with your children. I've done that with my children. I've done it with my grandchild. And I recommend that you do that because it gives them an edge or one up on the competition when it comes to their credit score, their adult report card, and their adult GPA, otherwise known as their credit score. So a thick credit file is important because it allows you to have a better credit score if you ever make a mistake. So think about it also like this. If you are healthy, in shape, healthy, eat right, get the right amount of sleep, if you get COVID, you don't die. Now, the only healthy people that I know that have died from COVID, the only healthy people I know of that have died from COVID is the 1,800 plus athletes that have died so far from sudden heart attacks and blood clots. And it's because they were also, well, I can't say that's what happened, but they were all vaccinated. And so generally what happens is when you're extremely healthy, your immune system fights off the bad stuff. And when you have a very thick credit file, your immune system, if you will, fights off those little late payments here and there. So it gives you a little bit of breathing room, if you will, or a little bit of oops insurance. And that's what this gentleman had. It was just a couple late payments, didn't have automatic payment set up, and they were just small credit cards, but a late payment's a late payment. So you want to have a thick credit file, thick as possible, because the thicker the credit file, the more oops insurance you have with it. I want to talk about eliminating the F's. So we have A's. Everybody wants to have A's, straight A's in school, straight A's in college, being the valedictorian and cum laude, whatever, with your college. But you want to eliminate the F's. And the F's are the late payments, the 90-day late payments, the charge-offs, the collections, the short sales, the foreclosures, the bankruptcies, the tax liens, the judgments. All of those negative things are the F's. So think about it this way with your credit score and your credit report. Your credit score is your GPA. The credit report is your adult report card because it's got all of the grades on it, and then your GPA is your score. If you were going to school and you had, let's say, 10 classes. In 10 of the classes, you got A's. Well, at the end of the year, you'd get a 4.0, right? Because you got all A's. Now, if you got 1 B and 9 A's, you still have pretty good grades, right? Wouldn't you agree? It's still pretty good. If you got 2 B's and a C plus, it's still okay. That's like in the 600s. If you had a bunch of D's and a couple F's, now you're getting down in that 400, that 500 range. So your straight A's would be 800 plus, or I should say 750 plus. Your couple B's here and there would be 740s to 750s. And it all depends on how you use your credit cards and how many loans you have and what kind of loans and how long you've had your credit and how many inquiries. All of that is impactful to your score, not just whether you were late or not. So the F's, though, are the things that we want to get completely removed. Because if we leave the F's on your credit report, the collections, the late payments, the judgments, no amount of A's is going to fix the F. So let me repeat that. No amount of A's, so no amount of positive trade lines on your credit report is going to eliminate the damage from the F. An A, or a 10-year-old trade line with no late payments and perfect payment history, perfect utilization rate, that's an A. That will help the B's and it'll help with the C's, but it will not help with the D's and the F's. And many times when I look at credit report, it's all F's. Last week I looked at a credit report. Every single count they had, every single account was an F. Late payments, charge-offs, collections. And then the accounts that only had a 30-day late that wasn't so bad, the credit card was maxed out. So those are F's. So we want to remove the F's completely from the credit report. And then we want to add more A's and B's onto the credit report. And a B in this example would be you go and you get a credit card. And now it's a new account on your credit, which is going to lower your credit score a little bit because it's new. It's within the first 2 years, but it's going to raise your credit score because it's now a positive account when we remove the negative account. If you maxed out that brand new credit card, that A or B becomes a C or D, depending on the rest of your utilization rate. So when it comes to your credit, think of your credit score as your GPA, your credit report as your adult report card, and think of the accounts as A's or B's. So what can you do to obtain more A's? Well, get more credit cards. You need to have at least 3 credit cards on your credit at all times. And with these 3 credit cards that you have, you don't want to spend more than 5% of the credit limit. So you want to keep your utilization rate below 5%. So what is utilization rate? Well, let's say it's $1,000 credit limit. Your utilization rate is how much you're utilizing of that $1,000 credit limit. So if you use $500, you're 50% utilized. If you use $900, you're 90%. If you use all 1,000, you're 100% utilized. If you use $100, you're 10% utilized. See how that works? So you want to keep it below 5%, but above 1%. So as long as you have at least 1% on there and you don't go over 5%, that's the perfect formula to make that credit card an A. If you go above 5%, it's going to drop down into the B category. Now, what you can do is if you're using your credit cards for your business or for your cash flow for your personal expenses, just make sure you pay off that credit card by the statement date or the report date. You can find the statement date on your credit card statement. You can find the report date on your Credit Mojo credit report. On the left-hand side, it says date reported. And then to the right of that, it'll say July 18, 2023, or whatever it says. That's the statement date. So you always want to make sure you have your credit cards paid down by the statement date, because that's when they report to the credit bureaus, not on the due date. A lot of people don't know this. They think it's the due date. It's not. It's the report date. How you obtain some A's. So the true path to financial success is mastering your adult report card. Because if, unlike your report card as a kid from high school or even college, employers do look at your adult report card. 70% of employers, 70% of employers look at your credit prior to hiring you. Businesses, banks. So that is your report card. It does matter. And I think it matters more than a college degree. I think it matters more than your GPA in high school or college. You know, unless you're a doctor or a lawyer or a CPA, maybe an engineer. I can't think of any other profession that really cares about your grades. I don't know about you, but I've never once had an employer ask me for my high school diploma. I've never had them ask me for my college transcripts. I've never asked me what my GPA was, ever. So that's how you master financial success, is mastering your adult report card.